those of you that don't know me, I'm Jane Jordan. I'm one of the medical directors in our child office, and I'm going to be spending hopefully about 20 minutes just talking about mergers, practice closures and partner exits. So starting with mergers, has anybody here gone through a merger? A couple?
Lucky lady.
We've done lots of work looking at mergers, not initially very many of which actually proceeded, but they are now seeming to pick up pace a bit, and I've had 3 mergers within my clients go through this month, but it is something that seems to be happening more and more. I think probably one of the drivers for that is GP recruitment and probably some of the property issues of which Andrew was talking about a little bit earlier. So if you're looking at merging with another practice, what should you do initially? Well, there are a few key areas, particularly with regard to the financial implications, where Lentells would be able to help you. And we would normally suggest that the first thing you should do is look at what your profits are and what the profits of the practice that you want to merge with are. And the reason for that is that actually if you want to merge with another practice who has profits which are significantly less than yours, that could be a stumbling block. So you don't want to get too far down the road and then actually look at the profits and go, oh, actually there's no way our partners can survive on such a big drop in income. So you do need to look at that at an early stage. And it may be that you look at the partnership's profits and say, actually there is a big difference, but there are things we can do to get over that difference. There are staff savings we can make. We can all move into one building. But you need to look at that at an early stage. And that's one of the key things that we can help with, because it's not actually easy just to look at your profits from your individual accounts. You will have all sorts of different things going on within those accounts in terms of what staff you're using, in terms of what sessions the partners work, how you deal with your indemnity subscriptions, how you deal with property. So it's really key that actually you get some professional involvement at an early stage and look at that. Now the other big issue when you're looking at merging is property. And effectively, profits and property are the 2 big stumbling blocks that could actually veto the merger going ahead. And property is difficult. And it's no good pushing it to one side and saying, oh, we'll look at that later, and trying to unravel what's going on. You really need to sort out what's going on with the property at the start. So you may have owned properties, you may have leased properties, you may have 11% mortgages with £200,000 redemption fees, you may have ex-partners who still own a share in the property, you may have a 25-year lease on one of the buildings. You need to sort out at the start what the actual position is on each of the properties, what the profits are, what the valuations of the properties are. Are the valuations less than what you paid out the ex-partner who left 6 months ago? And if so, is that going to cause a problem? So lots of areas to look at in terms of the property. There are solutions to sorting out all of those issues, but you need to know where you are at the start. So it's really important that you take some advice on that at the start. In terms of looking at any other significant assets or shares you have, generally most practices don't have huge amounts of fixed assets. You may have £10,000 or £20,000 of equipment, bits of computer equipment, desks, fixtures and fittings, not huge amounts. And if that's the case, normally when you merge, practices just bring in those assets at the book value per the accounts. There's no need to do a huge stock take, employing somebody to go around and add up what the value of your desks and chairs. But you might have some significant assets for other items. You might have just bought solar panels for £50,000. You might have spent £100,000 on a laser machine. There might be odd bits of fixed assets within your accounts which are worth a lot of money. So it's worth just having a look at that at the start. And most practices will own some shares, probably in a federation company, maybe a few £100, probably not worth worrying about. But some practices do own shares in other organisations, maybe in a pharmacy company, maybe in GP care. So you might need to look at valuing those shares and deciding what you're going to do on a merger. Are those shares going to stay with the individual practice? Is the joining practice going to have to buy those shares? So have a look to see whether that exists. And there might be other oddities which you will all be aware of within your individual practices. Do you have a separate limited company that runs a travel clinic? Do you have a separate company with a pharmacy in it? Do the partners own a separate property within a property partnership? Those sorts of things. So you need to be upfront and explain those sorts of things with the other practices at the start and come up with some plans about what you're going to do with those. Obviously, tax and VAT is something that you would need to get professional advice about. Tax in particular can cause a problem where you have two practices merging which have different accounting dates. Now, if you have a practice that has a June year end and they merge with a practice that has a March year end, traditionally you'll probably move to having a March year end. And what that will mean for the practice that has a June year end is that in the year of merger, those partners will probably be taxed on 21 months worth of profits in that year. Now, over the course of their career, they will be taxed on the same amount of profits, but you would just accelerate the taxation. But obviously for them, having to pay 21 months profits, tax on 21 months in a year, rather than 12 months can cause a problem. So get some calculations done by the accountants early so they can tell you how much the problem is going to cost. If you've had any building developed recently or spent a lot of money on an extension or building works, there might also be some unused tax relief on items within that building. So you would need to discuss with the other practice what's going to happen to that unused tax relief. Is it going to be shared through all the partners, or is it going to stay with the original partners so that they get the benefit of that? VAT. Generally, if a practice is VAT registered, it's probably because they're dispensing. And that doesn't necessarily cause a huge problem on merging. It just means that the other practice will be brought into that VAT registration, and they will need to now start charging VAT on their private fees and some types of medical reports. But if you are dispensing and joining with a practice that's non-dispensing, you will need to agree between you what's going to happen to those dispensing profits. If you're VAT registered because of property, perhaps because you've developed a new property, at that point really you need to go and seek some professional advice. We can advise you to a certain extent, but VAT and property is very complicated, and obviously there are big figures involved, so really you need to go and seek some extra professional advice regarding that. So these are the key areas really where we can help practices when they're initially looking at mergers, but there are other points which you will need to consider as well. So look at what contracts you have. So if you're both GMS or PMS, it's probably straightforward to merge your contracts. But if you've got a GMS and a PMS practice, potentially you might be able to merge the contracts. But what you want to do is get reassurance from the CCG that you're going to retain your MPIG or PMS premium money. And if that's going to be lost on merger, potentially you might need to keep the contracts separate, which isn't a problem. It probably just causes a bit more accountancy and admin work. You will know your partners, and the practice manager for a practice you're potentially merging with will know their partners. So have a discussion. Are they going to work together? Have you got one partner in your practice who has their own way of doing things, who is not going to change? Think about that, and actually are your partners going to be able to work together? And then a significant area for the practice managers to look at is going to be your staffing. So what sort of staff do you have? What level are they? What do you pay them? What do their contracts say? Are you going to have to make any redundancies going forward? And who's going to be the person in the firing line for the redundancies? Potentially the practice manager or one of the practice managers. So think about that, but there's probably a lot of work you'll need to do on staffing. And if you're going down the route of changing contracts, redundancy payments, get somebody like Kath involved, because it's very easy to get it wrong.
Costly.
Yes, and costly. IT systems, if you're both on the same system, probably fine, but if you're on different systems, you will need to decide which one you're going to adopt, when that's going to happen, and if any of your staff need to be trained. And obviously discuss at an early stage with the CCG to make sure that you have their support. It's normally not a problem, but you just need to make sure you've got that at the start. And in terms of your partners, I always think it's a good idea to have a little audit at the start, listing out all of your partners, whether they're property owners, what their ages are, whether you know of any retirement plans they've got. Do you want to merge with another practice where all the other partners are 59 and are likely to make a run for the door as soon as you merge? So get those things looked at to see where you are. And have a discussion about what the partner sessions are and what the expectations are going forward. There's no such thing really as a standard GP practice. Think about what a full-time partner is in your practice and the other practice. What do you do with your admin sessions? How long is a session? Is it 2 hours, 3 hours? Do you build the admin into that, or do they have an extra half day to cover that? Partners can get very precious about how they do things, so think about how you will actually work going forwards. And then we can have a look at different ways of allocating the income, but you probably need to have a discussion between you about what you're going to do going forward, particularly with things like seniority income, whether you have a PGA allowance, what happens to work income that partners earn in their own time, that sort of thing. And then obviously you've all got up-to-date partnership agreements with all the partners listed on them. So you would need to review those and check what the main terms are, and actually are they significantly different to the other practice. If you do go ahead with a merger, obviously you'll need a new partnership agreement drawn up, but what can help to keep the cost down is actually when you go to the solicitor, say, these are the specific items we need addressed. We've agreed 4 weeks sabbatical every 5 years, 6 weeks annual holiday, this and this, and get it all set out in the new partnership deed. But look at what your existing terms are to start with, because again, there can be big differences, particularly when you're looking at leave allocations and sabbatical costs. So just a few planning points. Please do allow yourself enough time if you're going to merge and you're going to do it properly. I would normally suggest about 12 to 18 months. We have seen mergers going through probably within 3 months, but if you want to do things properly, get all the property looked at, get the profits looked at, probably about 12 to 18 months. Please do take proper professional advice. The partners will probably be worried about how much that's going to cost, so you can of course get quotes up front for what the advice is going to cost, but think about actually if you don't get advice up front and something goes wrong, how much is it going to cost you to sort out the property 12 months down the line when it turns out there's a problem. And when you start discussing a merger with another practice, think about putting a confidentiality agreement in place. Not only because the other practice is going to be looking at your accounts, but also because you probably don't want staff to know at the start either. So rumours such as those could potentially mean staff becoming a bit unsettled, maybe looking at moving on. So get something set up initially about confidentiality, and also about how you're going to share any costs. So how are you going to share the legal fees between you? Are you just going to split them 50-50? Or is there going to be a bias to a larger practice? And make sure you've got the support of all the partners. So if one partner doesn't want to go ahead, they can potentially veto the merger. So you need to make sure that everyone's on board. It can also be an opportunity to bring to a head some issues with partners. So what I have seen in some practices where they've merged is actually there's been a particular partner who's been problematic, who they've actually taken the opportunity to get expelled before the merger goes ahead. Probably from pressure from another practice saying actually we don't want to merge if he's still working there. So you might have a green socks clause in your partnership agreement, which allows you to do that, but it does tend to bring matters to a head. So you almost need to get your own house in order initially before you start looking at working with other practices. So the key points really are, please allow yourself enough time and take appropriate professional advice.